Good evening, everybody. Thanks for joining us again. This week, I just want to take a look at what I'll call more traditional type of reversal patterns, and basically the types of patterns that we would look for, perhaps not with the traditional type of candlestick patterns. And these are still patterns that repeat themselves within candlestick charts, so they're just as useful to highlighting reversals if you're using that type of chart, but they do take longer to form than traditional type of candlestick reversals, which can be sort of 1, 2, 3 days or weeks, where the traditional type of patterns can take longer. They can take weeks, even months to form, but because of that, you might argue that they are more thought out. They're more of a sentiment shift that goes into developing this type of price action and the subsequent shift in sentiment and reversal in price action. Now, within these types of patterns, as with any reversal pattern, there must always be a clear trend having been in place already for the market to reverse. So you must have seen a prolonged advance or an extended decline for the market to form one of these reversals and to have it actually something to reverse in terms of positive or negative sentiment having been in place for some time. Now, for the head and shoulders pattern, which is probably one of the better known traditional type of patterns, there has to be 3 distinct peaks or lows, depending on the direction of the change that we're looking at, with the middle one higher to reflect a bearish head and shoulders, or lower than the other 2 if we're looking at a bullish reversal. Now, there's a trend line which connects the highs or lows, and this represents the neckline support or resistance, which needs to be broken on a closing basis to reflect a more serious shift in sentiment, completing the reversal, and then bring about a much more prolonged movement. Now, with the other type of pattern that we're going to look at, the double top and double bottom, this is where the buying support is unable to break through to the upside a previous peak or to the downside a previous low, where with the head and shoulders, that break would have been seen already. So that failure gives us 2 clear, distinct peaks within for a bearish reversal or troughs for a bullish reversal, again with closes above or below the neckline, as reflecting the important sentiment shift and confirming the directional change in price. Now, often with these types of patterns, once we've seen the completion and an acceleration away from the reversal, you will see a pullback, which is a recovery back towards the old support level, which then becomes resistance, or a correction back towards the old resistance level, which is then support, to give us another opportunity to enter the trade. Now, this doesn't always happen, but more often than not, it will be seen. So if you miss the initial break, then you will get a further opportunity to trade within the market. Okay, so let's look at the head and shoulders reversal. Now, this is natural gas on a daily basis, and it reflects, obviously, a very significant and bullish trend. Each correction finds support at a higher level each time, and the market then rallies and breaks above the previous peak. So in other words, we're tracing out a bullish trend. There's bullish sentiment that's dominating price activity. And at this point, it still looks as though that bullish trend is continuing. However, when we start to see the market correct and then bounce back, as we know, we've already discussed, when we start to see trend changes, you often see a weak test of the previous high or low, which represents a failure to break above the previous high and extend this bullish pattern of higher highs and higher lows, and then the market fails and sells off again. We then see further selling pressure developing, which takes us below the previous peak. So if we were just looking at this in pure price action terms, the fact that we failed to break to new highs, followed by a sell-off and a break below the last correction low, ends this bullish trend anyway of positive higher highs and higher lows. However, when we look at this in terms of a head and shoulders top, there are three distinct peaks within price action. We have the left-hand shoulder, which is the first peak, the head, which is the final peak, and obviously being the middle and the head, that is the highest trade of the pattern. And then the right-hand shoulder that forms when the market recovers and sees the weak test of the previous high, reflecting quite an important sentiment change in the fact that we've been unable to break above that previous peak, as we have done throughout the previous bullish phase. We then subsequently see the market sell off and close below the neckline, the trend line connecting the recent lows, to complete the reversal pattern. Now, for the measurement of the reversal, we take the height of the head and project it from the point of breakout, and that gives us a minimum objective, or an area that we would be happy to look for and project prices lower, having seen this head and shoulders top formation form. But the fact that we have the three clear peaks, where the middle peak or the head is higher than the previous two that form the left and the right shoulder, highlights that important sentiment change, with the close below the neckline reflecting that negative shift and a deeper sell-off risk. Now, volume is not always readily available on a number of charting systems, but if we think of it in terms of market activity, of what we're seeing behind these moves, as prices rise within a bullish trend, as the strength is seen, volume increases. And as the market enters correction, volume decreases. So activity is less as the market sells off. And as we start to pick up again, the activity within price action begins to pick up. And as we break to new highs, we extend the bullish trend. However, with this type of head and shoulders top, the first sign of a potential change comes as the market forms the first stage of the head. Activity is much less than when we've previously seen breaks to new highs. And as the market starts to sell off, activity increases. So we see a lot more selling pressure developing within the market that hasn't been the case with these previous corrections. And then as the market bounces back to form the right-hand shoulder, activity is significantly less. There's less commitment to the buy side. And that's why we see a weak test of the previous high. The directional bulls are not able to generate sufficient buying to break above a significant previous peak, as had been the case throughout the bullish move. So again, as the market then sells off, we start to see a pickup in activity. And then as the market breaks and completes the pattern, a more serious shift in sentiment begins to develop. Now, with a double top, instead of making that middle peak of the head, we actually see an earlier failure to reflect a lower peak, a weak test of the previous high, much sooner and much quicker than perhaps we would with a head and shoulders. So as we see the market trade back towards a level and then rally sharply, still within what is a bullish trend, we then have this last correction low as the important support. As the market then starts to rally up, we're always thinking about whether or not it's going to be a weak test of the previous high, a failure to break above this previous peak, followed by significant selling pressure, a close below the neckline, the last correction low of the bullish trend, and then that gives us the minimum objective of the height of the double top projected to the downside. So the theme within this overall structure with any of these indicators is that the weak test of the previous high is the first sign that sentiment's beginning to change within the market. And if we then develop that activity and start to see a break below the previous correction low, then this reflects a much more serious longer-term sentiment shift and the risk of a bearish trend developing. So if we now look at the price of gold, the current price of gold, we can see that the market in early 2021 saw a correction, and we hit a level where the market then started to recover from. So as with all of these previous correction lows, we then mark this as an important support level. The market then rallies back. Now, it's interesting because the first support level, the neckline, actually reflected a 38% retracement of the latest upside move. So it added strength to the significance of that support, not only when it was tested, but also if we start to break below that level. Now, what actually subsequently happened within the price of gold is as we then saw the acceleration into the recent peak, we retested the March 2020 high and then rejected significantly from it. We've then subsequently seen and marked this as a weak test of the previous high, for which the market has failed, rejected, and now closed below not only the neckline of this potential double top, but also the 38% retracement of the last bull run. So it's looking very much as though activity over the last 2 years within the price of gold could well be reflecting quite an important sentiment shift. And with latest weakness seeing closes below this last correction low, as a technical analyst, that certainly throws up quite an interesting question as to whether or not we're now starting to see more negative themes beginning to pan out for the price of gold and risk are towards lower levels. Now, this doesn't rule out reactions and recoveries within this move, but the evidence is still that this is a more serious potential shift in sentiment that can perhaps start to see pressure build from a longer term perspective. So I think it's very interesting when we start to see these patterns form, and if and when they are completed, it can potentially highlight a very important sentiment shift.